Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. We're going to rip through Twitter, see what people are talking about, see what information is being shared over social media. I'm going to give my financial opinions as we go through it. Most likely it's going to be related to a couple of topics. Commodities, financial type topics, or wealth building topics that I like to cover and talk about. So let's dive in there. And again, if you want to follow me at finding_finance, and if you want to join our community where you can take full advantage of this commodity bull market, I dive deeper into a lot of stuff on the website, finding-value.com. And that is, we still have a discount. It's called discount. It's $10 off the first month going forward. That September coupon code has ended, and we're just to the normal discount now. So let's dive in. We've got uranium, which is CCJ, Camco, to the money supply. So what is this doing? It's tying the relative value to something. So it's the value of Camco in relationship to the money supply. And Scott is the one who's doing this. So what a beautiful, it says, there may be red days, weeks, and months, but I expect a lot of fat green 3-monthly candles. What a beautiful one we've just had. Finished very strong and green. Looks like a proper breakout, just like we saw in 2004. So this is Camco in relationship to the money supply. Okay, so some people will say, well, that doesn't matter. Why does that matter? All right, guys. It's basically an inflation adjusted metric. Money supply, more or less, to a degree, is a measurement of inflation to some degree. And I know people are going to say, no, well, that's the consumer price index. We're producing products. Okay, guys. I mean, that's great that you want to argue all that. This is Camco's value in relationship to how much money is circulating in the system. Last time, Camco's valuation went to a ratio in this measurement area. Right now, we are very low still in relationship to this particular measurement area, which is the M2 money supply. Is it going to go exactly to this peak? I don't know, guys. We're going to have to wait and find out. What we're looking at is we're looking at the market conditions that changes the pricing of assets. Right now, those market conditions are present for uranium to gain in appreciation against other assets. One could argue, and I would make this argument too, that this bull market will not be as big as the coming bull market that is going to come. We could see an outperformance where this goes higher than the previous bull market against the M2 money supply. Why is that? Because the propensity for money to rotate and shift away from bonds and away from stocks could be greater this coming bull market. And I know that has nothing to do with uranium. I understand that. The propensity for investors to invest money from one sector to another depends on the market conditions that the investor is subjected to. If you have an increasing interest rate environment and we have a bond crisis where people get afraid of bonds and maybe even eventually currency itself, and the profound effect that the increasing interest rate environment puts on net present value calculations and the valuations of stocks, we could see a lot more money chasing after real things, real assets and hard assets, and the equities that provide those hard assets. So it depends on what the market conditions are coming forward. I think it's going to be a higher propensity for money to rotate and shift away from the financial assets into hard assets, given the interest rates and how fast and how large they are moving and to the levels that they're going to move to. That is going to cause a rotation of money into these assets. So Scott's right. We are in this type of environment where uranium is going to outperform, and we could see a big outperformance of hard assets against financial assets. M2 money supply currencies is a financial asset. So here's Longhorn. We got the Longhorn. Uranium peeps. This feels like optimism to me. Where are you? It says tip. The spot price is heading towards $100 in 2024, like a winning racehorse. And I don't know where the spot price will be in 2023 or 2024, but this is what they have for the Wall Street cheat sheet for the psychology of market cycles for uranium. He wants to say, where are we in this chart here? All right, well, I'll give you my feedback here for sure. Look what we've got here, guys. So here's my little den of uranium speculation. This is URA. URA is this guy here. This is the URA chart. This here is an overlay of previous bull markets and the herd mentality during that bull market overlaid on URA. Pretty good comparison there, huh? Now, if we look at the Wall Street cheat sheet, and I can blow this up. So let's blow this up. Here's the cheat sheet. All right. Now, if I were to take a guess of where we're at, there's two spots that I would guess. Well, 3 spots really. There's 3 spots. This big move lower into the anger level. Well, that's going to be probably here. This is anger down here. That's anger when compared to the chart. Okay, so that's anger down here. We bounce, we come down, and this here is basically the lead-in pattern and the double bottom that we get after it. Then this is your phase in the depression phase, which is the phase where you come up out of the bottom, but it comes and gets stuck. One could argue that anger is here, roughly speaking, and that depression is somewhere over here, and that this even could be included in the depression area. So one could say, well, that's depression. My retirement money is lost. How can we pay for this new stuff? I am an idiot. That's what it says under depression. That could be in this general section right where we're at. Another thing it could be is in the disbelief phase. This is a sucker's rally. When we look at that, that's generally in the disbelief phase. So in my opinion, this is the disbelief phase where you get your first move out of depression. This is your first wave out of depression. This is your pullback, and that is your disbelief phase. Your disbelief phase is the phase that they call the bear trap. So the bear trap, and I'll just kind of go back and forth here, guys. Your bear trap is this one here. So this is the valley of despair is what I call it down here. This is your breakout of that valley of despair. Now you're over here in the stealth phase. The stealth phase is over here. You get this nice kind of whatever. You get your first move up, and then your bear trap. This here could be your bear trap. That's what it is. You have another bear trap up here as well. And I think this is the first one. I think this is basically the one that is down in this area down here in disbelief. Right here, disbelief. And we haven't entered hope yet. We are starting to kind of enter that hope. And that hope's going to increase, in my opinion. So I think we're leaving despair. We're going to be coming into hope. And then optimism is over in this section over here. This is optimism up here. This is your media attention, enthusiasm. That's going to build as we go up here. So we're coming into hope. We're leaving disbelief. We're coming into hope. And then we're going to go into the optimism phase. The optimism phase, if you were to look, your optimism phase is really the one above this consolidation zone. It's this flag pattern that you get out of that consolidation. So I think optimism will be somewhere over here, wherever that is, and then you get the blow-off peak. This blue line that I have, the fractal is what I call it. That fractal is from this is from the previous bull market in natural gas. And this is a equity that I grabbed it from. And look how it overlays over all this stuff. Now, why do I think that this is in the disbelief phase? Is because every single commodity is in the same exact cycle as this is here almost. I think that the size of the moves will depend on the particular commodities, supply demand characteristics. But this is across the board. It's not just in uranium, it's in copper, it's in dry bulk shipping, it's in uh, oil and gas, energy service, it's in copper companies, it's in everything, guys. It's in everything that's commodity related. Now, if it's in everything, what does that mean? It means that the money coming out of the other sectors, like bonds and stocks and tech companies, that is what's causing the movement. The movement in its entirety is not caused by supply demand fluctuations of the individual commodities. If that was the case, then we would be seeing these things bottom at different times. But we're not. We're seeing it bottom all at the same time, for the most part. Yes, there's going to be leaders. Yes, there are going to be laggards. But this is driven by money rotation and financial assets eating it. And we're seeing I'll call it the propensity of the move will accelerate as more people in the system lose faith in either the bond market or the currencies market, and the money's going to rotate faster and faster. And I think that is what is occurring, breaking out of the disbelief phase. So that's where I think we're at. Disbelief and entering hope. So this guy, he says you can't make this up. Median mortgage payment is $2,900. The median rent price is $1,900. It now costs $1,000 a month more to buy a house than to rent. Meanwhile, the average new car payment is now this. The average interest rate on a used car loan just hit a record 14%, all while credit card debt hits $1 trillion for the first time ever with record interest rates at 25%. Basic necessities are becoming unaffordable to Americans. The only thing I'll say here is I don't think he can do this calculation. Why do I say that? Well, the median mortgage payment, that's your middle mortgage payment, and this is your median rent price. In my opinion, there are a lot more people who rent apartments, townhouses, and smaller structures than there are that people who buy condos or townhouses. I think there's a lot of people in here. If you're looking at the median mortgage payment, a lot of people start their life out renting, and then they save up, and then they go buy something. I see a lot more people with families who own homes than rent homes, at least personally. So if that's the case, then the median mortgage payment is going to be on a larger structure that costs more than the median rent price, which is probably going to be an apartment or a two-bedroom apartment or something. A two-bedroom apartment isn't the same as a mortgage payment on a three-bedroom or four-bedroom house. So the way that a lot of these people put this up here, I don't think this is a fair comparison. Now, a fair comparison, if I were to take homes in my block, your mortgage payment depends on how much you put down. So a lot of people say, well, I'm not going to put anything down. Well, that's not a fair comparison, guys. Like, you want to set up the life where you want the lowest payments possible. Okay? You want the lowest payments possible. So what do you want to do? You got to put a chunk down on the house. You tie some money up into it, okay, but you get a really low mortgage payment. If you can refinance or have financed at a very low mortgage rate. And that's what I did. Now, I understand that the interest, rates have gone up. They've gone up substantially. I don't know if those low rates are ever coming back. And I don't know if the affordability is ever going to go back to the levels of ludicrously low levels like the early and mid 2010s. That is an anomaly in history. So again, people are comparing affordability to an anomaly in history, which was the cheapest time to buy a house. Then they're looking at the interest rates, and then they're making bad and poor comparisons between these two because I don't think they're even. My guess is there's a $400 or $500 difference at most between buying and renting in the area that I live. But it depends on your down payment. Depends on your down payment. And that's with the 20% down payment. Here's more uranium from Scott. This is yellow cake, relentless move up. It's going to turn at some point, guys. It's not going to go straight to the upside, but at some point it will turn. We'll maybe get a pullback or maybe not, but we may not go straight higher. So don't have your expectations thinking that we're just going to go straight to the moon. Possible, but I think we'll get some pullbacks along the way. Big, small, indifferent about it, whatever. But we'll get some sometimes. Uranium says for companies with resource reserves in the ground, not unreasonable to expect that the pounds in the ground to be valued at 10% of spot price. E.g., $500 pound spot is roughly 10%, which is about $50 per pound in the ground. Many in good jurisdictions, etc., are trading below $1 a pound. So what does that mean? If you're about $1 a pound and it goes to $50 a pound, you just made 50 times your money. That's a market cap gain of 50x. Now, is that going to occur? We don't know. We don't know what the spot price is going to be. We don't know if the valuations of equities are going to be priced, when they're going to be priced against the uranium price. What does that mean? So if the uranium price were to go higher, let's get some fresh movements here. We can delete that. If the uranium price goes like this for the entire bull market, right? Uranium equities are going to go up during a certain portion of this, and I think they're going to kind of jet down. And then they're going to peak somewhere like this. And even though the ultimate futures pricing of the uranium might be up here. So there's going to be a disconnect. So the ratio is going to peak, I think, before the peak of the actual commodity prices up here. So that's UX1. That's your futures pricing. This here is, say, URA, which is like the ETF. And I think this ratio is not going to, it's going to turn where the equities start to underperform and you get a blow off top, perhaps in the commodity itself. I don't think they're going to align perfectly. That's what happened during the last bull market, and I think that's probably what's going to happen during this bull market. That's my guess. So it depends where the equity valuations also turn against the spot price. So if $500 a pound was the ultimate price, well, maybe it turns at $400 a pound. And I know he's just using this as an example. It's a 10% pounds in the ground valuation in relationship to the spot price. JP Morgan forecasts an increasing supply deficit of 1.1 million barrels per day by 2025 and 7.1 million per day by 2030. We're seeing the signs that I discussed in the latest chapter from abundance to scarcity in energy. As a result, inflation has become secular, which is a longer-term inflationary movement. The combination of bond crisis, which is inflationary, layered on top of a supply restriction, is just absolute fire for gold and silver, guys, and platinum. Absolute fire. So again, I think that the energy area looks really good, and I think precious metals are also going to wind up to be pretty good. And the gap here, OPEC supply growth, there's this gap between the demand here and all the growth that we've got out in the future. And we get these supply gaps out in the future, and the way that they resolve themselves is higher prices. There's not actually going to be a gap. It's going to be demand being destroyed is what's going to happen. This is great. You got the big breakout on SPUTs. It's stretching out as expected. Hugely bullish chart, big picture, and beautiful. Uranium miners did 370% in its baby bull move, and present move has been strong. This commodities bull is and will be end of the rainbow stuff. We have a long valuation runway ahead of us, guys. We're just breaking it out. A historical breakout on a 15-year base. I'm going to be honest, guys. We're not going to break out and do nothing here. This isn't you don't break these patterns that are over a decade long and go nowhere. They're going to make a big move. And I don't think people have their mind wrapped around this in the correct manner. This is, guys, I have to laugh at all of this. I just feel like I'm trying to make sure that people understand the gravity of this move. When we look at something like, I'm going to bring up silver real quick, okay? Here's silver, and I'm going to put on logarithmic on a big picture view, guys. This is silver. I always want to try to do this, all right? Here's silver, all right? What this is telling us, this is an inflationary move with a supply constraint in oil back in the 1970s. It started back here, okay? Big move. Silver ripped it. We've got a large pattern on silver. This is a cup, and this is your handle. Or you can draw the handle like that. We are about to break this to the upside. And I know that we've been dilly-dallying around here on the tip here. We could pull back here. We could move back further. We could. Okay, so what? If you take a long enough time frame and you had yourself with a little bit of time, this thing is telling you that there's an inflation problem or a bond crisis or something coming that's big. Something big is coming. Now, if you tie this silver chart, which is a big chart pattern, the projected move on logarithmic basis, and I'll just give it to you straight up. I don't really care. People are going to say I'm crazy, whatever. There it is, 280 bucks projected price target on silver is the cup size of this. If we were to break the cup line there, okay, 280, 250, 215, whatever it is, somewhere in that range. All right, that just doesn't happen out of nowhere. There's a reason a market condition is coming that's going to launch silver upwards. There's a market condition coming that gold is going to break the peak of this here and rip to the upside. Why do I think that? Because it's all interconnected. This deficit in oil is going to cause an imbalance in the system. It's going to cause people to get afraid of inflation. It's going to cause people to shift their actions in the markets towards other assets to protect wealth. It's all interconnected. Those charts are interconnected with the supply gaps and risks. There's a reason crude oil, when we look at crude oil, there's a reason crude oil is breaking to the upside, putting in a third leg. There's a reason that we've got the commodity to stock ratio breaking into its third leg here from a very underdepressed low level. There's a reason that all the money was pushed over in the S&P 500 at the end of a 40-year decline in interest rates, and all the money's piled over here. There's a reason that commodities are at 100-year lows when compared to 200 years worth of data, or its all-time lows, I should say. It's all interconnected. There's a reason that gold divided by the M2 money supply is putting in a ridiculously big double bottom. Remember that chart that I had pulled up for URA? Let's do this here real quick. I want to show you guys some things. All right. Here's gold divided by the M2 money supply. Here's your chart. All right. I'll put it right here. This is your chart pattern for gold in relationship to M2 money supply. This is your bottom here, okay? This bottom here is your depression and disbelief. So depression goes up, disbelief. We rip it here, we come up, we come back. There's your disbelief phase. And then we go into optimism and then belief, thrill, and then euphoria at the peak. That's the upper side. Now we go into a long period of complete crushing despair against gold. And I know gold's gone up a lot. I understand that. People are not looking at it from this lens. They're not looking at it from the lens of gold compared to other assets and the monetary system. We come on down. This here is your capitulation. This is your anger in here. We've got anger. We've got, so this is capitulation. This is anger down here. And then we've got depression. We're in depression for gold, guys. Depression. How do I know that? Well, I know that because of the chart right here. Gold in relationship to the money supply is in depression. The depression phase. What is the depression phase? Let's read it one last time. My retirement money's lost. How can we pay for this new stuff? I'm an idiot. Nobody likes gold, guys. It's a barbarous relic, whatever, barbarous, how do you say it? And we haven't even moved off the bottom in relationship to a lot of these assets. It is dirt cheap. So we're down here in this depressed area, and nobody wants these assets. Well, except for me. So why are we in this depressed area? 40-year decline in interest rates, guys. 40-year decline in interest rates. There it is. 40-year decline. And what's changing? We've broken out of that decline. We have broken into a new paradigm where assets are going to get repriced. Period. And the reason they don't want gold to go up is because everything gets indexed to gold. It's a barometer of a measuring stick in the system. And that's why if you were to look at, say, like, uranium divided by the gold price, see how we're rounding on all these, rounding on up? We're going to see a big outperformance of uranium futures and all these other commodities against gold. And gold is going to be a rising asset against the M2 money supply that I just told you. Gold is in depression. Gold that you measure against is something that is in the dirt. So uranium is going to outperform an asset that's going to go way up. And that's going to go up even further against something that's depressed in the dirt. We're going to see something that is going to be unbelievable, I think. And you can take crude oil divided by gold. All these assets have been in a bear market for a little while, and now we're starting to break to the upside. This is going to get, it's going to feel like we're in a different world, I think. These assets and the way that they're going to move against each other is going to be incredible. All interconnected, guys. Here's one of the many charts I used to call the commodities bear market low back in April of 2020. The false breakout was obvious back then. And when it breaks above the blue line, next bull up leg will start. The red positive divergence looks good. We are positively diverging down here in the stochastics and the MACDs. We're coming into the corner here, squeezing up. What does this look like? This is the industrial metals area. This is copper, steel, iron ore, all of those things. And guess what? Those charts look beautiful. I've got a bunch of different setups to take advantage of this bull market move. I am here to help you guys become successful in finding and capturing these moves. Now, of course, we're at a 61.8% retracement right now. That retracement level is holding, which is also a support level back here. So we have a lot of things in the market here, guys, that are very unique setups. They've happened in history before. They just haven't happened in people's lifetimes that are living that remember anything. I mean, they're usually in the older generations who lived through the 1970s. So a lot of people don't know what's coming. I'm not saying that I know exactly what's coming. I'm just saying I think something big is coming. All I'm looking at this, I'm just looking at all these different charts and different assets over long periods of time and trying to piece together the puzzle. And I'm going to bring people on who can help me piece this all together, this big puzzle. So look for more individual interviews with people. I'm going to be asking a lot of different questions and digging, trying to get whatever information I can out of these guys. So obviously, I subscribe to the channel, guys. That'll help me out. Give me a thumbs up to help me out. If you want to join our community, you can do that. Lots of good investable picks right now are occurring, I think, over this, now, next month, and over these few months. When we start into the bull market, we really start to hit it to the upside. those entry points aren't going to be as good anymore. So I think you need to be looking now and getting prepared for what I think, whatever this big inflationary push is coming. So that's what I've got for today. We'll catch you guys later. This is Finding Value.